Whoa.
Before we get into the dividend cut, let's just quickly recap what went down with Discovery and WarnerMedia combining. The rationale that AT&T gives to merge WarnerMedia with Discovery is that a few points here, it unlocks significant value for AT&T shareholders. It will accelerate HBO Max and Discovery Plus's global plans for direct-to-consumer. Very interesting, creates one of the deepest content libraries in the world. More on that in just a second. And they expect to generate $3 billion plus per year in synergies that can be reinvested into content and direct-to-consumer. Briefly go over the structure that Discovery will contribute 100% of its business and receive 29% of common equity. AT&T will receive $43 billion in a combination of cash, debt securities, and WarnerMedia's retention of certain debt. AT&T shareholders, that's me, will receive 71% of common equity distributed via shares of stock, and it unlocks value in WarnerMedia. Shareholders can participate in the potential upside of new company. I argue that this will indeed turn WarnerMedia into a growth company. The footnote down here excludes certain assets including Xandr and Crunchyroll if you're not familiar. Xandr is the advertising and analytics division of WarnerMedia Commercial, which is a unit of AT&T's WarnerMedia, which operates an online platform called Community for buying and selling consumer-centric digital advertising. AT&T will be hanging on to Xandr and to Crunchyroll, which is an American distributor, publisher, production, and licensing company focused on streaming anime, manga, and dorama. I find it encouraging in this key criteria that they want better engagement, lifetime value, and subscriber growth. That is something that they are going to need if they want to compete with Netflix and Disney Plus. Now, this is really impressive when you see some of the brands, personalities, franchises. They have a library with over 200,000 hours of video content available in over 220 countries, so that's going to give global exposure. And it is the #1 TV studio by revenue and volume, top 2 movie studio by box office, 11 of the last 12 years, and sports rights, premium sports rights, with NHL, NBA, Major League Baseball, DC Comics, Warner Brothers, that's going to be huge, HBO. Take a gander at some of the March Madness, PGA Tour, the Olympics. Very interesting. And the portfolio will be positioned as stronger partner to advertising and distribution counterparts. And the combined company pay TV portfolio reach can compete with combined pay and broadcast network reach of other global payers, aka network television, and Netflix is who they're going to be going after. $52 billion of expected revenue and $14 billion of expected adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization in 2023, targeting those $15 billion of direct-to-consumer revenues in 23, and the robust free cash flow will give them reinvestment and financial flexibility. They expect to rapidly deleverage within the first 24 months. This really sums up what they're doing with spinning off WarnerMedia is they want to focus on their wireless and fiber. They are a telecommunications company, and that's what they want to focus on with their management team to execute on AT&T's efficiency and effectiveness transformation and to simplify the AT&T investment thesis and align assets with appropriate investor base. Positions AT&T for revenue growth, margin expansion, and earnings growth. I argue that this could indeed turn AT&T into a growth company if this merger does complete and move forward. And the AT&T 5G wireless, they spent a bunch of money, which we covered in an earlier video. They had bid on the C-band, and they plan to expand fiber reach to 30 million customer locations by the end of 2025. This is what's got everybody in a tizzy, is the dividend. They're targeting a dividend payout ratio of 40 to 43% on anticipated free cash flow of $20 billion plus. This Kiplinger article explained it really well, that which we covered, annual dividend payout ratio of 40 to 43% on $20 billion expected free cash flow implies a total payout between $8 billion and $8.6 billion. So this would represent a steep drop from the $15 billion AT&T paid in dividends in 2020 when free cash flow came to more than $40 million. Morgan Stanley analyst Simon Flannery points out that it would mark a nearly 50% reduction from current levels and would put the stock on a low 4% yield. Hey, what's what's up? I'm Russ. This is Dapper Dividends. Thanks for investing a little bit of your time with me. I'm not worried about 4% dividend yield. Ask people who are invested in ABV, ticker ABBV, as I am. 4% yield is really nice. Realty Income pays a 4% yield. 4% is solid, not to mention that we are also going to be receiving shares of the new company of WarnerMedia, whatever the spinoff will be called, and they may also pay a dividend. It continues, although income investors might have to accept less in the way of dividend income, that doesn't mean this is automatically a bad deal for them. And they point out that it bolsters T's balance sheet, that the telco took on tremendous debt when it acquired Time Warner. As of March 31st, AT&T carried net debt of $169 billion. And although AT&T is spinning off its media assets, the structure of the deal with Discovery still allows current T shareholders the, quote, potential to profit from the growth of streaming media and content in general. Whether the new media company pays dividends remains to be seen, but it certainly will have higher growth prospects than AT&T. Now, given a choice between acquiring new media assets and spinning out a pure play, we believe shareholders are benefited by the latter, writes Bank of America analyst David Barden, who continues, a combined entity would have an enhanced ability to offer the widest variety of content to attract the largest possible subscriber base on a global basis. I'd have to agree with Mr. Barden that this is going to benefit AT&T's shareholders. Now, I saw on social media today there was a lot of panic and people just hearing the word dividend cut and selling right away. I think that's why there was such a steep sell-off with AT&T, as people are just trying to get out before this dividend cut. A lot of things have to happen before this goes into effect. Discovery shareholders still have to approve this. It has to be approved by the SEC. That has to go through. It wouldn't happen until 2022. So there's about 4 quarters or so of dividend payments left from AT&T. There's still a lot of things that have to happen with this. And on top of that, we still don't know if the new WarnerMedia entity is going to pay a dividend. Imagine selling and you're forfeiting the new shares that will be given out, that we will have a new stake in, a 71% stake. And we don't know if it's going to pay a dividend. So if it does pay a dividend, I'm still holding AT&T. I want to see how this plays out. I like that they're trying to compete with the likes of Netflix and Disney Plus. Those are 2 behemoths that they're trying to go after. And I think they had a good thing with HBO Max. So I think this is still, I'm standing by my position. This is going to be a benefit for Discovery, for AT&T, and for the shareholders alike. Let us know what you think in the comments section below, because you know where the comments go. Expertise really does come from you out there in the community. We would like to hear from you. Follow me on Twitter at RustyRam78. I can chat with you there. And if you know a kid or you're a kid at heart, check out this video I did on dividend stocks for kids with Hasbro. It's the first in a series that I'll be doing one of each week, and I will talk to you in that video.